All right. Okay. Welcome back, everybody. Welcome back. Ed Ponsi here, your FX educator, here on behalf of FX Street. One more time. Great to be here. Good to be back. Here on a Monday. And Monday in the middle of June. It's June 19th. Oh, it's almost summer. Boy, oh boy, time flies, huh? It's good to be here. Almost summer here in the northern hemisphere anyway. Don't know where you might be, but it's great time of year up here. Okay, um, just getting started up here. Anyway, a little bit after 9 a.m., so we're getting ready for the U.S. stock market to open. Looks like stocks are going to open close to all-time highs in the U.S. Just bull market just doesn't want to quit, and that means the yen is falling. Um, Even though, as we said, some of those big tech stocks that led the way most of the way this year are falling, that just means the leadership has changed hands to other stocks. The market itself is not falling, and the market is rising, and that means the yen is falling. So you can see the dollar beating up on the yen here. We had a great trade here. We're out of that trade now. We hit target 1, target 2, and then we had that big day where we had, I guess it was the Fed meeting, and we had so many different items going on that day, and elections and whatnot, and we just said, the heck with it, we're closing out the trade. So this was one of our best trades recently. It was a 400 pip winner, and on dollar yen, and so we're out of that. And look, it's going the other way, so I'm glad we're out of there, and it's rising. So what do we do with this thing now? Well, I don't like to, after a big win like this, or right after getting out of a trade, I don't like to get back in. Oh, I've noticed that I used to do that, and I know a lot of people do that. After they get out, they like to get back in. But to me, a lot of times that's an emotional decision, to get right back into something after you've just gotten out. It's almost like you never got out if you get back in, especially if you, of course, if you get back in on the same side of the trade, it's like you never got out. And I like to, there's a lot of times there's something that I don't know what you would call it, maybe emotional residue from a trade. Like I still feel, I look at that chart, and I look at the fact that yeah, we hit 2 targets. So we didn't make it to the 3rd target, but we made good money on the 3rd target too, because we closed it out because of event risk. And I feel kind of proud about it. And you know what? That makes me not want to trade it again, because it makes me think it's dangerous to trade it because I feel some sort of emotion toward it. And that's bad. It doesn't matter whether it's a positive emotion or a negative emotion. Any emotion at all is likely to cloud your judgment. I look at that chart and I feel a little bit happy. A little bit, because yeah, this was a really good trade. But I don't want to trade dollar yen at all, because the first thing I look at when I look at a chart shouldn't be happiness. It should be analysis. The first thing I look at, I shouldn't feel anything. I should look at a chart and think, okay, where do I buy? Where should I sell? I shouldn't feel something. If I feel anything, I should go to the next chart. Let's go to the next chart. Maybe Euro Yen might offer us a different opportunity. Not loving this chart. Oh, I'll tell you what though. Maybe Aussie Yen or New Zealand Yen. Show me something that's trending here. This looks like it might be a bit of a breakout. I'm going to start pulling up the moving averages. Exponential. We were talking about trading techniques as we finished the previous session. Somebody was asking, what do you call your trading technique? Well, we used a trading technique on the earlier session where we were talking about just trading using price, right? Just price action. And this is going to be something different where we're looking at moving averages. It looks like we're getting a little bit of activity here. Little support here on the Aussie yen on the 10-day exponential. And now it's taken off. So maybe if it comes back to that 10-day, it might be worth a look. Carlos says 85.40 is a key area. I'm going to drop a line there at 85.40 and back it up a little bit. And I can see exactly, as I back it up, which is always a good idea when you're talking about Carlos, because Carlos, I know, looks at longer term. And as I back it up, I can see Carlos knows exactly what he's talking about. This was huge support. And it was also resistance. It was resistance here. So this is an area where reversal becomes very likely. Now, I'm thinking of buying a dip to that moving average, which is now 83.55. So if it pulls back to around 83.55, realistically 83.50, a little bit lower, because if it comes down today, it's going to depress that moving average a little bit. It's going to push that moving average down. So if it comes down a little bit, I've got maybe 200 pips of upside before it hits that area, but I can see exactly what Carlos is saying. If it comes up to that point, it actually becomes potentially a short for the same reason why we were talking about shorting pound today, because this is an area where the price tends to turn. The price just seems to have a lot of memory of this number, and the price has a lot of tendency to turn at this point. This is a big turning point for the price. All right, over the past year, right? It's a huge turning point. You could even go right there. Right? I mean, I don't want to be too picky about it, but you could if the closer I look, the more of them I see. There's just a lot of turning points at about 85.40 on Aussie yen. So So if I buy, it becomes a point where you want to take profit, either get out of the entire trade or get out of part of the trade if I'm long. Conversely, if I'm out of the entire trade, I could use it as a point to sell short. So I could play it both ways. In other words, look where we are right now. We're basically at 84.50. We're halfway between buying it down here or selling it up here. Where's it going to go to first? I have no idea. But I don't have to know. That's the beautiful thing about being a trader. Trying to guess whether it's going to come up to 85.40 or down to 83.50, which of those things will happen first, that's a guessing game. And if you're playing guessing games, that's not trading, in my opinion. That's guessing. That's prediction. And to me, trading is not about prediction. And as soon as I figured that out, that's when I began to win. Okay? But this is exactly the type of thing that I would do when I was new to trading. I would try to guess what was going to happen first. Is it going to get up to that line, or is it going to come down to that moving average? As long as I was trying to guess, or not even guess, I would analyze my guts out to try to figure out which of those two things would happen first. I would read every article, look at every chart, analyze every indicator to try to figure out which of these two things was going to happen first, not understanding that there's no way to know which of those two things is going to happen first. And that's not how you do it. That's not how this works. Okay? Once I understood that the way this works is it doesn't matter whether it gets up, which one happens first. What matters is knowing what you're going to do. I know exactly what I'm going to do if it comes down to 83.55, right? I buy here, and I know exactly what I'm going to do if it comes up to 85.40. I sell short here. Now, I can create a game plan around this, but that's the basic idea. That's the basic outline. Now I just have to flesh it out, right? Now, as far as buying it at 83.55, that's easy because I have a very well-developed game plan for that. I use half of the ATR to place the stop, right? And that's a technique that I call FX Ed. And I wrote about that in Forex Patterns and Probabilities 10 years ago. The ATR is 76 pips. So my stop would be half of 76. My stop's going to be 43 pips if I buy it down here. Simple. And my target, well, what I'm probably going to do is close half of that trade just before 85.40. And the rest of it, I'm just going to trail the stop under the moving average and just hold that long position until the price breaks through the moving average and stops me out, which hopefully will happen somewhere up here. Who knows, right? Some of these things can run for a very long time, right? So that's the easy one to figure out, is what I'm going to do if I go long. But I don't know if it's ever going to make it down. I'm not predicting that the price is going to come. People say, well, Ed, if you know the price is going to come down here, why don't you just short it? Well, because I don't know if the price is going to get down there. I'm not into prediction. As soon as I stopped predicting is when I started making money. I don't know if it's going to come down there, but I know exactly what I'm going to do if it comes down there. So this is not a game of prediction. This is a game of reaction. Okay? Prediction, no. Reaction, yes. And if the price comes up to here, then I'll be a seller. Exactly how? Well, stop probably goes above that wick. That way, if the price continues higher and makes a new high above that wick, I'll probably get out of that trade, right? Because I don't want to stay short if the price is making new highs. That's generally against my philosophy, right? If something's making new highs, I don't want to be short. If something's making new lows, I don't want to be long. Right? That makes sense, I would think. Okay? So, anyway. So anyway, that's the general idea, right? So let's try to flesh that out a little bit more, right? So if that's how old is that? You're thinking, well, that resistance area, that's a couple months old. Well, it's mid-June now, right? So that's 2.5 months ago. You're saying, well, Ed, why does that matter? It's 2.5 months ago. Well, listen, anybody who's looking at a chart is also going to be looking to place the stop. They're going to be looking at the same area. And Carlos says, yeah, it could go to 86.60. Yeah, I mean, I'm looking at this. If it breaks through here, what's to stop it from going all the way up to here? Do I want to stay short as it goes all the way up to here? No, absolutely not, right? So you got to draw the line somewhere. So if I enter short here with a stop here, that's my risk. My risk is going to be from here to here, right? And my target could be all the way down to here. My target could be from here all the way down toward 83, because look how fast the price came up. It's the same thing as here, right? You see how fast the price came down? Here's why I don't want to stay short. If the price breaks this high, because the price came down so quickly, there's no support, there's no resistance in here. If the price breaks through here, it could go straight up to here. Well, the same thing happened here, right? If I'm short, there's no support in here. if I'm short from here, the price could drop all the way down to here, because here's the next support level just above 83. So you see what I'm saying? This is like it drops off a cliff. Price just drops off a cliff here, and when the price falls that rapidly, it doesn't, what they call back and fill. It doesn't create any support and resistance. So yeah, long here or short here with a stop here and a target here. Pretty simple. But you're not predicting, I know what to do if it drops. I know what to do if it goes up. Let's try to put some numbers on this. So short at 85.40, let's say. And I'll make that green. Now this high is 85.32. 85.32. Now I want to be above 85.32. How about 80? I'm sorry, I'm reading the wrong number. The high is 85.75. 85.75 is the high. I have to be above 85.75. How about 85.80? With the stop, 85.80 for the stop. Okay, so my entry is basically this line, 85.40. My stop is just above that high. My ultimate target could be way down here. It's not 83, but it's really just above 83. Do you see how there's resistance here? Boom, I can't get through. 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 Boom, and then boom, it finally makes it through on this big candle here. So I'm thinking kind of like this. If I go like 80, just say 83.50, I'm just going to spitball it here, 83.50 for my ultimate target. What's my risk reward if I were to use 83.50? Because that puts me above all of this mess. See all this mess here? I put the line above all that mess, and I'm getting out above all that mess. 85.40 to 83.50 is 190. The risk is 40. So 40 goes into 190. That's darn near 5 to 1. 1 in 5. Right? So that is darn near 5 to 1 risk reward. It's pretty darn good. I'd probably throw a 1 to 1 in there. Maybe close out a third of the trade at 1 to 1. Just give me a chance to move the stop down to break even. And we've got us a trade. So we've got ourselves a trade set up. So what would be 1 to 1? What would constitute 1 to 1? The stop is 40 above, so 1 to 1 would be 40 below. 85.40 minus 40 would be 85 even. Well, that's great. That's a round number. 85 even is the preliminary target. And here we've got another setup based on price action. This is the short trade coming down. And then the long trade would only execute if the price came down first, and we would buy it on the 10-day exponential moving average, which is this blue line that's coming up. So we can always revisit this. I think I'm back with you again tomorrow. I don't know if it's going to hit either of these today, but I'm back with you again tomorrow just in case and we'll figure it out together. What do you think? You know, because this is kind of a sweet chart because, you know, I'll tell you, I like the fact that it has that rapid move kind of opens up a lot of space. You know, it opens up a lot of possibilities. I don't like it when the price is contained in a narrow area. I'm back with you again tomorrow for 2 sessions so we can revisit this setup and see if anything happens with this. So we have our odds. So we've done 2 setups today. We've done actually 3 because there's 2 setups on this chart. Right? We've got a long setup and a short setup. So this to me that's what it's all about. We're not trying to figure out which way it's going to go. We know that we don't know. You know, and when I was in my first year of high school, one of my teachers told me something that I never forgot. He said, to know what you know and to know what you don't know is the mark of one who knows. And right there, that was the price. That was worth the price of the entire education right there. I know that to know what you know and to know what you don't know is the mark of one who knows. And this is something that I've told a lot of my students, and I put it in at least one of my books. And I credit it to Lao Tse. He credited it to Lao Tse, although I've been told that similar statements were made by other philosophers over the years, perhaps Socrates, maybe, I don't know. But the point is, if you think you know what is going to happen in trading, and this is what cracks me up, because I meet people all the time who think that they know what's going to happen. I'm going to tell you right now, I know that I don't know, and I know that you don't know. So when you tell me that you know what's going to happen, I already know that you don't know. All right? And if you know that you don't know, then you also know that nobody else knows. And you realize that the smartest people in this business, the most successful people in this business, you never hear them say that they know what's going to happen. You'll never hear them say that. And when you're new at this, you wonder, well, if these people are so smart and they're so successful, why do they never tell me what's going to happen? They don't know what's going to happen. But they know that they don't know what's going to happen, and that's why they're successful, because they know that they don't have to know what's going to happen in order to be successful. All they have to do is figure out what they're going to do. Okay, if A happens, I'm going to do this, and if B happens, I'm going to do that. I've got my plan in place, and now I just have to follow through. Now I just have to, because you worry about the things that you can control. Here's what I can control. I can create a plan like this, and I can execute it flawlessly every time. That's what you can control. I can control it. You can control it. You can create a plan, and you can execute it flawlessly every time. That is within your control. What is not within your control? You can never be able to accurately guess every single time what's going to happen. You might be able to occasionally guess correctly what's going to happen. And if you do that a few times, that might be detrimental to you, because you may come under the false impression that you now have the ability to see the future. You cannot see the future. Okay, let me get off the soapbox here. All right, let's see what else is going on out there, ladies and gentlemen. Pretty exciting. I love this stuff, though, man. It's exciting stuff. Mr. Fitzsimmons taught me that, though. Know what you know what you don't know. Right? That's the stuff. That's the good stuff right there. Yes, it is, says Carlos. He knows, too. He knows. You know what you know what you don't know. All right. Yeah, nothing much exciting happening today. 2.17 on the 10-year. I keep a close eye on that, because it's almost like the market is totally disregarding, and they're only having 3-month auctions, 6-month auction. I'm really paying attention to the 10-year, Treasury interest rate, and the 10-year Treasury right now is 2.17%. The truth is, the market is acting as if the Fed did not raise rates. The market is totally ignoring the Fed, or acting as if the Fed is going to have to undo those rate hikes later on. It's funny, isn't it? It's the market is acting as if the Fed is irrelevant at this point, and I have no idea. I'm not going to tell you that the Fed is irrelevant because I don't know if the Fed is irrelevant. I'm not that smart. You know, I don't know. I know that I don't know. You know, but all I know is the market is cutting interest rates while the Fed is raising them. But the market's cutting rates on longer-term bonds while the Fed is raising short-term interest rates. Somebody asked last week, I don't know if I explained this properly or I had to explain it very quickly because we were at the very tail end of a class. What is the Fed actually raising rates on? It's an overnight rate that banks lend money to each other overnight. That's what the Fed funds rate is. And the Fed is trying to raise the rate at which banks lend money to each other overnight. And somebody said, it was a brilliant question. Why do banks lend money to each other? Because a lot of people don't realize it. Banks lend money to each other every day. They do it constantly. It's because banks actually have very little money compared to the amounts that they lend out. A bank might only have 2%, 3% of the money that they actually lend out. They have to keep a certain minimum in-house. And in order to maintain that minimum, they might have to borrow it from another bank. And so they borrow from another bank, and they have to pay interest. And that's an overnight loan. They're just borrowing. They're just saying, so Citibank might have to go to JP Morgan and say, hey, JP Morgan, I just need to borrow some money from you overnight, just overnight, so I can meet the requirements. And so they borrow it overnight, and the Fed funds rate, the interest rate that the Fed raised last week, is the target rate that the Fed wants banks to charge each other for overnight loans. That's it. That's the rate that's the interest rate that the Fed raised. Isn't that crazy? You think the bank has all this money, but the bank doesn't really have all that money. The bank has very little money compared to the amount that it's lending out. They only have a tiny fraction of that amount. And sometimes they don't even have that. They have to borrow it from another bank. And that's why you have terms like LIBOR, London Interbank Offered Rate, right? I asked my dad once, does God exist? He answered, son, I don't even know if I exist. That's brilliant. That's actually brilliant. Brilliant philosopher. Your dad is a brilliant philosopher, Carlos. But that's the overnight. Yeah, that's the overnight rate. But people think these banks have all this money. So when LIBOR shoots up, you know what happened in 2008? LIBOR shot way up because the banks were scared to lend to each other, even overnight. It's like there were really bad rumors that one of the banks was in trouble. Lehman Brothers, right? So banks said, yeah, okay, I'll lend you overnight, but I want 4% because I'm afraid you're not going to pay me back. You know, I want a really high interest rate because I'm afraid I'm not going to get this money back. Okay, and that was when all those rumors were out there that Lehman Brothers was in trouble. There were rumors about Lehman Brothers for a good 6 months before they finally went under. So when you see the LIBOR rate going up, even if you don't know what's going on, all you have to know is if you see the LIBOR rate beginning to spike, you know something's wrong. You don't have to know what's wrong, but if the banks are beginning to raise the rate sharply that they lend to each other, then you know one of them might be, there's at least a rumor. They know something you don't know. They always know something we don't know, right? So if you see that the LIBOR rate is spiking, LIBOR is the rate at which they lend to each other. So if they're afraid to lend to each other, what does that tell you? There's something really wrong at one of those banks, right? Maybe it's time to short the banks. If you see LIBOR spiking, short the banks, or at least don't buy the banks. Get the heck out of the banks. Don't buy you're going to see bank stocks falling. Don't buy them, right? Short the banks. Yeah, maybe short them when you see LIBOR spiking. Might not be a bad idea. Might not be a bad idea. All right, but it's an exciting world. It's an endlessly fascinating world, right? The world of finance. I mean, you could just go on all day about this stuff. It's incredible. It's incredible. And so LIBOR spiked in 2007, 2008, and it wasn't until and Lehman went under, and then it was systemic because they all owed money to each other. So you thought, okay, anybody who was owed by Lehman, now they're not going to get paid, so they're going to go under. And that's when the feds stepped in, the federal government stepped in the U.S. and said, okay, we're going to make sure that nobody else goes under. And that's when LIBOR dropped, and that's when people realized everything was going to be okay. And that's when the market stopped crashing. And that's when, but up to that point, when Lehman went under, there was no guarantee right at that point, there was no guarantee that that was the last one. A lot of people thought that could have been the first of many. But it wasn't, very fortunately. Okay, gang, that's going to do it for today. We got some great setups today, and let's check back in tomorrow, see how they work out, all right? This is Ed Ponsi, your FX educator. Speaking to you on behalf of FX Street, I just want to say thank you for listening. I had a great day. I hope you did too. Everybody have a wonderful day. I'll talk to you very, very soon. Everybody take care out there. See you later.